Good evening, everyone. Welcome back from the weekend, and hope you guys had a nice day. My name is Kamagapa, the insurance guy, and welcome to the AfterMath show, hosted by me, the insurance guy. We have had so many episodes talking about insurance and investments, talking about financial instruments in the market. So today or tonight, we want to talk about the difference between a life insurance policy and a unit trust fund. How do they differ? Basically, that they're all good investments. So you need to explore the opportunity that the life insurance policy has and the unit trust fund has. Yeah. So the viewers out there, I don't think a life insurance policy is beneficial to you, especially if you're one that has dependents, people you care about, either your spouse or your children. You need a life insurance policy. And the unit trust fund is meant to to take care also of your short-term and immediate goals. Now, those instruments are good, but they're highly regulated in the market. You see, by insurance companies, by the regulator IRA, by UBRA, Retirement Benefits Regulatory Authority, by Capital Markets Authority. So all these instruments are highly regulated. So it's important for you to at least purchase one of them. Now, question is, why would I buy a life insurance policy and not buy a unit trust fund? Or why would I buy a unit trust fund and not buy a life insurance policy? Yeah, so we need to discuss and dissect the benefits or the differences between those two financial instruments. Yeah, today I will talk about a life insurance policy basically, and probably in our next episode I'll delve more into the differences of the life insurance policy and the unit trust fund. First of all, what is life insurance? People say, when you meet someone tells you my life is insured by God, I would have insurance by God and such things. But basically, life insurance is all about, it's a concept that was created to have financial relief to a human being when certain risks of life happen. Yeah, it's a model that was created sometime back in the 1800s, 1700s to create financial relief to a human being when certain risks of life happen. Question is, what are the risks of life that can happen to a human being? There are about 5 of them that can happen to a human being. So when they happen, is there financial relief to that person? The question is, when you have a life insurance policy and those risks happen, what happens later on? Yeah. So there are about five risks that can happen to a human being. Shall talk about them, then later on shall break them down. One, the risk of living so long. It's a very big risk. That is retirement. Have you planned for your retirement? The risk of getting disabled, yeah, the risk of getting an accident, the risk of dying, and the risk of becoming critically ill. So those financial risks that a person faces, they're very, very critical. So when they happen, what is your fallback position? Now that's when the financial risk comes in. That when you happen to die, what happens to your children's education? So next time we shall talk about more on those 5 risks and how you can mitigate them, and then get some money from insurance company. It's been your host Kamoga Pai, the insurance guy. See you next time.